in the fixed income space, the aggregation of risk is not necessary. Most people have assumed if they buy a fixed coupon 5-year corporate bond, they're going to have interest rate risk, they're going to have credit risk, they're going to have seniority risk. In other words, is it a senior debt, subordinated debt, equity, so it's different places in the capital structure. They're going to have volatility risk. There are at least 7 different factors that are built into a fixed corporate bond. You don't have to buy all of those together. So if I look at credit specifically, there are 2 obvious factors there. There's interest rate risk and there's credit. So if you're IBM and you're issuing a bond, when you go to issue a 5-year bond, you start from a baseline of where are 5-year interest rates. And where are 5-year interest rates is basically what does the government pay to issue a 5-year bond. So that's considered the risk-free rate. Any corporate is considered to be more risky than the government, and they will pay a spread above the government. And that's the credit component of buying IBM. So when you go to buy IBM, and if you're buying fixed rate, you're saying, wait a sec, probably the vast majority, particularly in today's market, of what I'm getting is actually government risk. It's what is the government willing to pay in that currency to borrow in 5 years. Only a small portion is the spread that IBM pays above the government. If I want to actually buy IBM risk and I want to think about the risk return of buying IBM, I want to slice off just the spread element of the fixed rate bond, because that's comparable to the equity markets, because there you're getting IBM risk. In the equity markets, you're buying the first to default element of IBM risk. In the senior debt, you're buying the first to get paid and therefore the last to default risk. One of the things that people also need to understand is that the key thing that you're buying in the credit markets is implied versus realized default rates. So the implied default rate of a credit is what that credit pays an investor to take risk against them. The realized default rate is how often do they go bankrupt. And so if you look across the investment grade markets, what you'll see is that default rates, for example, for the last 10 years are minuscule. So the number of investment grade issuers who have gone bankrupt in the last 10 years, we've had a very strong economic cycle, is very low. On the other hand, they have been paying reasonable spreads for that whole time. So they've been paying people to take risk against them, but people have not been having to give that money back in the form of a default. So the skew has been in favor of people who are buying implied default risk.